Welcome everyone to First Thursday, and the Asset Protection Council presents today tax considerations of asset protection planning. My name, of course, is Douglas Lodmell. I'm the managing partner of Lodmell & Lodmell. We are an asset protection only law firm, and of course the founder of the Asset Protection Council, and that is our network nationwide of attorneys, CPAs, financial advisors, and other professional planners that are seeking to enhance their practice with asset protection. So I really appreciate everyone coming on today. Every month we get more and more. This is quite a well-attended webinar, and this one is going to be great. I am a tax attorney. I have an LLM in taxation, and so it's very interesting because I really focused on trying to make the planning as simple from a tax standpoint as possible. And that's one of the benefits of the way we do the planning. So you're going to see that today. You're going to see what the tax considerations are, how we deal with them, and how they're different from other types of asset protection plans. So let's get started. I'm going to review our plan just so that we're all on the same page and we all are talking about the exact same thing. So you've seen this before. I want to make sure that you see it again. Your clients want four things. They want it to be effective. They want to have control. They want it to be free, and they want to have zero compliance. So we try to give them as much of that as we possibly can. So our planning is absolutely effective. It's not free, but it's very reasonable, and it's certainly maintainable. What does that look like for the normal average guy that comes in the door? There's three tools that we're most likely going to use. And I want to get them out here because these are the same tools we're going to talk about, the tax considerations. So the three tools are the limited liability company. I think we've all used these inside of asset protection, outside of asset protection. It's a very common tool nowadays. The asset management limited partnership, which is a limited partnership, and we'll talk about how that is very similar to an LLC from a tax perspective. And then the asset protection trust, and that's really kind of where we're going to have the most interesting conversation. Okay, the limited liability company. In our planning, we use it to protect risky assets. We use it to segregate assets into separate LLCs. So if a client has an office building and he also has a strip mall and then he has 4 rental houses, we might do 3 separate LLCs for that so that they're segregated. Again, the example I use is an actual client who had an LLC in California before he called me. He had $3 million properties in there. One of the properties had a mold problem with a potential liability of $5 million. So he had 3 properties in one LLC. They were all at risk. So what we did, of course, is get them segregated, get the properties separated. So now you have 3 LLCs. They can all, in turn, flow up to the limited partnership and connect to the bridge trust. But that's the idea behind the limited liability company. It has charging order protection to some degree or another, depending on the state that we're actually organizing the LLC in. But to some degree or another, it does have charging order protection. The next tool is the asset management limited partnership. It's the same type of tool. It's what I call a COP entity, or a charging order protection entity. That's how it protects assets, is that a charging order is an order that says a creditor cannot get into the underlying assets of the partnership or the LLC. They can just get a charge against that member or that partner's interest. And so it stops somebody from actually getting into it. The difference between your average run-of-the-mill LLC and the asset management limited partnership is that the asset management limited partnership is, one, it's a limited partnership. There are reasons why I consider a limited partnership stronger than an LLC. They have to do with the fact that it's an older tool, it's more defined, has more case law. Additionally, we set it up in Arizona, and Arizona has really been solid about making sure that charging order is the exclusive remedy. So we really like the limited partnership. That's why we use it as the family holding company. That's where we're going to consolidate the assets. It can hold the safe assets directly. That's the cash, the stocks, the bonds, the notes receivable, and it can hold the interest in the LLCs and the other companies, whether it's the C corporation, the LLC. What it cannot hold, I'll just throw in here as a bonus piece of information, is it cannot hold S corporation stock. For that, we have to use the bridge trust. S-Corp stock has restrictions on ownership. It can only be owned by an individual person or a special qualified subchapter S trust, which the bridge trust can be if we need it to be. The Asset Management Limited Partnership, as I said, has what I consider enhanced charging order protections in Arizona. They're really, really good. And we want to take advantage of every possible advantage we can for our clients, and that's why we use Arizona. And it's a great place to include your family and, of course, the Asset Protection Trust. So it's a very good tool, and we like it a lot. It does create a level of privacy for your assets. And it's not about secrecy. Don't get the James Bond conversation in your head. We're not trying to hide anything, but we're also not trying to advertise anything. We can make the limited partnership pretty much completely secret. By using a Wyoming LLC as the general partner, we can make it really impossible for someone to figure out, at least from the external direction, figure out who owns the limited partnership. And we do that with certain clients where privacy is really a concern. Okay. Then we have the bridge trust. This is the trust that is an asset protection trust. When we say bridge, we mean it's an offshore registered foreign asset protection trust, but it's bridged back into the United States for 7701A30E tax compliance, which means it's considered a domestic trust from an IRS perspective. That means that it's very simple to maintain. Assets can be moved across the bridge if we ever have a problem. It's connected to the domestic structure, which is the Asset Management Limited Partnership and the LLCs. It's not limited to any kind of risk like insurance, which is insuring fire risk or car risk or professional risk. The bridge trust covers all of our clients' assets regardless of risk. Again, privacy, it's not registered anywhere in the United States. It's not something anybody can look up and find. And it is just an incredibly powerful tool. Here's how it all fits together. Asset Management Limited Partnership, that's your main holding company. Then you have your LLCs that own the rental property, that own the boat, that own the airplane. All of these are going to go into the limited partnership. You have the bridge trust. And then you have your revocable living trust, which most of you, when we're talking about clients, you've already done for most of your clients. So how does this work? The LLCs go into the limited partnership. The limited partnership can also hold those safe assets that we talked about, the cash, the stocks, the bonds, the coin collections, all of that can go straight in there. Who controls it? The client controls it, either directly as the general partner or through an LLC, like we discussed. And sometimes we'll use a Wyoming LLC for privacy. Who owns it? The bridge trust owns it. We're talking about 98% or 99%. In other words, the vast majority. So what happens? Well, what happens is if the client dies, we're going to pass these assets down through the revocable living trust. And they're going to distribute. We're going to maximize the estate tax exemptions. We're going to avoid probate. We're going to smoothly pass the assets. And it's going to be private because we don't have probate. But what happens if we have a risk? Now we go and reset. If we have a risk, the assets can be transferred. They already are owned by the bridge trust. They can be moved into the bridge trust, and the bridge trust, if necessary, can literally physically take those assets offshore, move them away from the U.S. courts, the U.S. judges, the U.S. jurisdiction. That's the power of the Asset Protection Trust. So what are the tax considerations of this structure? Well, let's start with the easy ones. Limited liability company. LLC does not have to file a tax return if it's a disregarded entity. Well, what makes it a disregarded entity? Being a single member. And the single member, if there's just one member to an LLC, then it is considered a disregarded entity from an IRS perspective. And in that case, all the activity is reported on that single member's return. Well, in our structure, if the single member is the limited partnership, then the rental income, the lease income, or whatever it is that could occur is reported right up to the 1065 of the limited partnership. This is really an advantage because I have clients that have, I don't know, maybe 15 different LLCs. And instead of having 15 tax returns plus a 16th tax return for the limited partnership, we might have just one tax return. which is the limited partnership, because the LLCs create the legal distinction, but since they're single member, they don't require an extra tax return. Now, I'm going to anticipate a question, which is, well, what about the fact that single-member LLCs may not be seen as protective as multi-member LLCs? Well, we had a great case in Florida called the Olmstead case. There's a brief on it at the Asset Protection Council website. And in that case, the Florida courts actually pierced a single-member LLC of Mr. Olmstead because he was a single member. But it was Mr. Olmstead that was the single member. So two things occurred that I think are interesting. One, if the single member LLC is in turn owned by a multi-member charging order protection entity, well, then you're right back to full protection. So that's certainly the case with our planning. So that's the first interesting thing, is that the piercing of the veil doesn't really apply because we still have the multi-member in addition to a second charging order protection entity on top of it. The second thing is that the Florida legislature went in and clarified that they didn't want that to happen again, and they changed the law. So the whole concept of the single member LLCs kind of being too weak to use, I don't agree with that. I think that they're too simple and too advantageous to not use. I think we have to look at them. There are times when we want an extra tax return, so we'll do it. We'll make sure it's a multi-member. But most of the time, the simplicity and ease of maintenance for the client far outweighs some incremental law school type theoretical benefit of having a multi-member. But it is case by case, and of course when we work with you, we discuss those considerations and we make a determination. Single member LLC that is a disregarded entity and that does not have employees and does not have any excise tax liability also doesn't even need to get an EIN number. Again, talk about simple. 15 LLCs, 15 different compartments of protection, one EIN number and one tax return. The accountant will thank you, the client will thank you, and you're going to have a happy client. I just value so much simplicity, and clients value simplicity. It's why we use the bridge trust, because we want ultimate protection when the time comes for it, but we want to feel comfortable having the simplest possible structure from a maintenance standpoint, because that is truly what makes happy clients. And that's what makes happy lawyers, right, is happy clients. So keep it simple is my philosophy. I think Einstein said it, it should be made as simple as possible, not simpler. If you do have a multi-member LLC, then you do need to get an EIN number, and you do need to file Form 1065 and perhaps, depending on the LLC, state tax return as well. Arizona does not require a tax return even for an Arizona entity if it's not actually doing any business in Arizona. Okay, asset management limited partnership. Very similar. It's a pass-through entity. There's no additional tax created. It does require Form 1065. An asset management limited partnership will never be a disregarded entity. Why? Because it's always going to have more than one member. By definition, a partnership has more than one member. You can't have a single member partnership. It doesn't exist. Again, one of the reasons why I like limited partnerships incrementally a little bit better than I like LLCs. I like both, but as the holding company entity, the limited partnership just has a little bit more beef to it. Each partner is going to get a K-1 for their share of the partnership income or loss. So it's going to be real straightforward. That K-1 shows up on that partner's return, whether it's itself another corporate return or whether it's a personal return. So if our client is the general partner and our client is the limited partner, then the client gets the K-1. It shows up on their 1040, and again, all the taxes are paid. Straightforward. EIN is always required. Why? Because it's going to have a 1065. This is a good thing. For the holding company, we want an EIN. We definitely want that separate entity, because this is where we're going to be really standing behind that charging order protection. Okay, now let's talk about trusts. I'm going to talk about all three versions, because domestic, international, and the bridge trust. I'll start with domestic. Domestic, all of them, and again, for anybody listening who hasn't been following all of the webinars about the trusts, when we talk about asset protection trust, we mean self-settled spendthrift trusts that are grantor trusts. There are other types of trusts that are not bad that some planners call asset protection trusts. So we have a very specific meaning to it. Our meaning is the industry standard meaning. It is what we all in the industry understand is an asset protection trust. It's a self-settled spendthrift trust in which the settler is their own beneficiary and they're setting up the trust for their own benefit. It's grantor. It's an incomplete gift. We're not talking about a trust where the assets are outside of the estate. In those type of trusts, they are tax neutral. The income is taxed directly to the settlers. An EIN may be required. It depends. Normally, no separate tax return. 1041 may be required, but if done right, you neither need an EIN or a 1041. There's no foreign trust IRS filing requirements in a purely domestic asset protection trust. Those of you listening who know me well know that I don't recommend purely domestic asset protection trusts. Not from a tax standpoint. I think from a tax standpoint they're fantastic. But from a protection standpoint, I feel like they're insufficient because they are too subject to the U.S. jurisdiction. That gets us to the Foreign Asset Protection Trust. Foreign Asset Protection Trust, EIN, is required, and a 1041. It's still a grantor trust, so there's no extra tax. We're not talking about an extra tax, but once you have a foreign trust, you do need to get an EIN and file the 1041. It does require also filing forms 3520 and then each year 3520A. These are really important forms. If the client fails to file them, there's a 35% of the assets of the trust penalty. That's a massive penalty. So you really don't want your clients to miss this. It's one of the reasons why if you don't have to subject your clients to these forms, I would recommend you not. It does happen where clients just fail. The accountant fails, the clients fail, something happens, and the forms don't get filed, and now they're really in trouble. Again, Foreign Asset Protection Trust, still a grantor trust. So the income is still all taxed to the client, to the settlers. And if the trust owns foreign accounts, then we have yet another set of disclosures, which is the FinCEN, the FACTA FBAR disclosures. So if you're not used to international work, these might be new to you. It's the FinCEN 114 under the FBAR rules, and I put FACTA in there because FACTA has additional forms that need to be filled out, and they continue to kind of evolve that. So you kind of stay on top of it, see what now FACTA, what they want disclosed. Bottom line is that the IRS wants to know where every dollar in this world is. American dollars, foreign dollars. Their goal is to have a full accounting of every dollar in the world. The way they do that with the U.S. taxpayers is they make you tell them where every dollar is. Again, this does not subject you to any extra tax. It's just something you have to file. And it only applies if you have foreign accounts. It's informational to the IRS only, so it doesn't create any additional tax. But I want to say that when it comes to these requirements, I have, over the years, clients have expressed very clearly that they prefer not to file these things if they don't have to. I personally agree. I just think if you do not have to file these, don't. My feeling is that the Foreign Asset Protection Trust is by far the strongest version of the trust we could have if you're defending the trust. That's where we want to be. And if we're defending the trust, these things are just part and parcel of what we have to advise the client they're going to have to do if we're defending the trust. If we're not defending the trust, why would we want to subject our clients to these forms? And that gets us to the Bridge Trust. The Bridge Trust is treated as a domestic grantor trust for tax purposes. It's tax neutral, as are the other two. Its income is taxed directly to the settlers or the grantors, as are the other two. There's no separate tax return. There's no IRS filing requirements, because I can tell you for sure the way we draft the trust and the way we advise our clients to hold trust assets gets you into the exemption from having to get an EIN number or having to file a separate tax return. So we're talking about a very, very easy to maintain trust. There's no need to open up offshore accounts. By and large, I don't recommend clients go running off opening up offshore accounts. Most of them have advisors here that they're quite happy with. They have banks that they're quite happy with. Our goal is to protect the assets, not get into the money management of what it is. We recommend offshore accounts when we need them, when clients request them, when you request them for clients. We don't advise clients to just go ahead and start opening up offshore accounts. Which gets to this slide. Regardless of whether the trust is foreign or whether the trust is domestic, if the trust opens a foreign account, it's got to comply with the Foreign Account Tax Compliance Act, FACTA, which includes the FBAR and the FinCEN. So I just want to make it clear, it's not that the trust is foreign or domestic which subjects you to FACTA. It's whether you have an account or not. If you have a personal account in your own personal name offshore with more than $10,000 in it, you're subject to FACTA. So it has nothing to do, in fact, with whether the trust is even there. It's about the account. So again, be aware of this when you have clients that say, I came back from a cruise and I set up an account in Grand Cayman. I thought it was really cool. All they needed was my driver's license, and they're subject to FACTA. So it's very important that you understand that to advise the clients. That's really it. That's the great thing about asset protection, the way we do it, is that we really keep it simple. We're really talking about typically one extra tax return from the pre-asset protection plan client. That one extra tax return is the limited partnership return. It's a federal return. It's not even the state return. If you live in a state that has a franchise tax like California, they want the franchise tax on any entity that you are a member of anywhere in the world. So you're just going to have to comply with that. So pay the franchise tax. So if you have an LLC that you own 0.01% in Timbuktu that is controlled by somebody else, and none of the business is done in California, and nothing is anywhere near California, but your 0.01% limited partnership interest or limited liability membership interest, California believes that they should get $800 from that LLC. That's California. That's just the way it is. There are some other states where, again, you have the same types of considerations locally. Comply. That's the answer. But in general, from our perspective, it's very straightforward. One extra tax return. If you're using the bridge trust concept, which it is the cleanest way to do it. You really have no compliance. We don't have to worry about clients missing the filings of the 3520. We really don't have to worry about anything. It's very simple. Once we explain this to CPAs, they get it. I do have a tax compliance letter that if anybody would like on this entire structure, particularly which explains the bridge trust and how can an irrevocable grantor trust not even need an EIN number. I can give you chapter and verse on that. And so that's it. Thank you again. And as always, if you have a client or you have a prospect that you want to talk about asset protection, the best way to do it is just to get on the phone with me, email me or email Coletta, say, I've got somebody I want to set up a conference call with Doug. We'll talk with them. I'm very happy to talk with someone, even if you're not sure if they're really a good prospect or if they really need asset protection. We'll do an analysis. I'll make a recommendation, and I'll support you if we're going to do the work to get it done. If you have any questions about the program, about how we work, about the tools, if you're not yet a member of the Asset Protection Council, then you can go to the website right here, and it says Become an Affiliate Member, and you can follow these 3 steps, and you can become a member. If you are a member, but you're not yet up on the member directory, which is right here, then I suggest you call Kitty or email kitty@lodmell.com, and you get yourself up. Everybody here has a web page, and as you can see, the web page gives a bio of them. I posted an article, and then it'll click through to the individual website. This is just an advantage to you. It's one more link to your website. It's one more way clients can find you. So I really recommend, if you haven't gotten if you're a member and you haven't gotten yourself up here, get yourself up here. So I really appreciate everyone, your attention. I hope you all have a great April, and I will see you next month.